Warning, the stock market is fast approaching what I like to call the sell everything moment. And that means a near 25% decline in the broader market in just the first 9 months of this year is likely just an appetizer for what's to come. Now, the average bear market decline since the 1930s is about 35.5% from peak to trough. In this case, an average decline would take us back to the 3,000 to 3,100 range on the S&P 500. Now, unfortunately, given the likelihood of recession, still elevated valuations in many corners of the market, even now, and the scale of the current inflation problem, I believe an average-sized bear market could prove a conservative downside target, and we could actually fall much further than that. You see, there comes a stage in every bear market where the narrative shifts from selling specific troubled stocks and industry groups to selling virtually everything. For example, check out this chart showing the progress of the 2000 to 2002 bear market. Now, this chart shows price-only returns for 5 market indices on a weekly basis from the end of 1999 to the end of 2003. This period represents the end of the late 90s bull market, the entire 2000 to 2002 bear market, and the beginning of the ensuing 2002 to 2007 bull market. As you can see, the leadership groups of the late 1990s bull market and the leaders on the downside from 2000 to 2002 were the Russell 1000 Growth Index and the NASDAQ 100. The S&P 500 Energy Index and the Russell 1000 Value Indices were leadership groups in the subsequent 2002 to 2007 bull market. Of course, the purpose of the S&P 500 is to represent performance of the broader market, so that's all stocks and industry groups. So simply put, thanks to that sort of averaging effect, it's going to hold up better than the worst performing groups on the downside, but lag the top performing groups on the upside, by definition. What's clear is that during both bull and bear markets, not all industry and style groups follow the same schedule. In the 2000 to 2003 period, tech and growth stocks experienced what technicians, or chartists, would call a blow-off top. Now, that's a final speculative burst to the upside, followed by a crash. Thus, the NASDAQ 100 was up more than 20% within just the first 3 months of the year 2000, only to collapse some 35.7% from its March peak to its May low, a period of just 2 months. However, value stocks in the S&P 500 Energy Index didn't follow that same pattern. Both sectors lagged growth in the blow-off top phase and then continued to trend higher through the year 2000. Now, if we look at the year 2000 as a whole, the S&P 500 was down 9%, just 9%. But the NASDAQ 100 collapsed 36.8%. And the Russell 1000 Value and S&P 500 Energy Indices were actually up by 7.3% and 15.5% respectively. In other words, if you were not overweight technology, then the year 2000 didn't feel much like a bear market at all. In fact, many value investors enjoyed their best year since at least the mid-1990s, back in 2000. Now, in 2001, the broader market began to weaken even more, led once again by those same technology and growth stocks. By the end of the year, the NASDAQ 100 was down a devastating 57.4% over the 2-year period from the end of 1999 through the end of 2001, and the S&P 500 was down about 20%. Yet value and energy remained somewhat insulated. In the 2 years ended December 31st, 2001, the Russell 1000 Value Index was still up by 1.5%, and the S&P 500 Energy Index remained up almost 4%. As you can see from the chart, it really wasn't until the summer of 2002 that value stocks and energy began to break down alongside the rest of the stock market. In just the 3 months of July, August, and September 2002, value slumped 18.7%, and energy was down more than 20%. Of course, taken as a whole, value stocks and energy held up far better than growth. Technology and the S&P 500 through the 2000 to 2002 bear market. What's more, by the end of 2003, energy and value had already staged a massive recovery, even as technology and growth remained down more than 60% from their year-end 1999 close. However, there was a stage of the bear market in 2000 to 2002 when sellers stopped being selective. All stocks and sectors began to fall as the bear market sort of broadened out. Now, something similar happened in the 2007 to 09 bear market. Different players, similar story. In this cycle, the leadership group on the downside was financials, which declined more than 80% from their high in 2007 to their low in early 2009. However, unlike the 1999 to 2000 cycle, there was no blow-off top in financials. Instead, financials began to peak and decline actually a few months before the broader market reached its top in October 2007. The selling in the group then intensified quickly into early 2008. The Russell 1000 Value Index underperformed the broader market through this 07 to 09 cycle because the largest weighted group within the value index is, you named it, the banks, which also happened to be the hardest hit group amid the credit crunch of that era. However, not all groups participated on the downside immediately. In fact, from the end of June 2007 through the end of May 2008, the Russell 1000 Growth Index was actually up about 1.4%. This relative strength was a good early signal growth would be the leadership group in the ensuing bull market. However, just as in the 2000 to 02 cycle, there came a time in 2008 when even stronger groups like growth and technology in that cycle just couldn't withstand the selling pressure anymore. Starting in the summer of 2008, the bear market broadened out to include virtually all stocks and sectors. From the end of May 2008 through the end of the same year, through the end of December 2008, the Russell 1000 Growth Index tumbled more than 37%. Now here's a look at the current picture. Here's a look at the experience, in fact, from the end of September 2021, roughly a year ago, through the end of last week. As you can see, the broader market S&P 500 peaked in early January of 2022. However, this cycle's downside leaders, which have been the Russell 1000 Growth and the NASDAQ 100, peaked in late December and mid-November respectively of last year. Meanwhile, value and energy stocks have felt little pain for much of the year. As recently as just a month ago, the Russell 1000 Value Index was still down less than 7% year to date, and the S&P 500 Energy Index, well, it was up an impressive 51.5% just since the beginning of the year. Now, I'd glean two main points from this pattern. First, I strongly suspect the sectors showing good relative strength over the past year, which includes energy and value stocks more broadly, will prove to be the leaders of the next big bull market when it comes. Of course, that does not mean a new rally or bull market cycle is imminent. As I've explained in several of these recent presentations I've given, I suspect the eventual bottom of this bear market is still months in the future, probably not before early 2023, maybe even middle of 2023. Second, I believe the sell everything moment, when even these stronger groups in the stock market get hit, is fast approaching, or in light of the action over the past few days, may already be upon us. Warning, selling pressure is likely to broaden to include stocks, sectors, and indices that have been relatively resilient so far this cycle. Fundamentally, the main driver of this is a crucial shift in the market narrative, from fears of rising interest rates and Fed rate hikes to fear of declining economic growth and recession. Just consider, we can break down the price of any stock or equity index into two basic fundamentals. First, there's the expected earnings, and second, the earnings multiple, more commonly known as the price to earnings ratio. For example, on the last trading day of 2021, the S&P 500 closed at 4,766.18, and we can deconstruct that price into an expected 12-month forward earnings, that's consensus Wall Street earnings expectations for the year ahead, of $215.25 per index unit, and an earnings multiple, price to earnings ratio, of 22.143. So on Friday, September 30th, just last week, the S&P 500 closed at 3,585.62, which we can disaggregate into Wall Street earnings estimates for the index over the next 12 months, so the coming 4 quarters, at $229.81 per index unit, which would be a multiple of 15.6 times. So as you can see, earnings estimates have actually risen. The entire decline in the S&P 500 so far this year is entirely due to a decline in the price to earnings multiple investors are willing to pay for stocks. Again, not a decline in the outlook for corporate earnings yet. So that brings me to this important question. What drives earnings multiples? What drives the price to earnings ratio for the stock market? Truth be told, there are several factors that drive PE multiples for the S&P 500, many factors. However, one of the most important is short-term interest rates and the near-term outlook for Fed policy. Take a look. This chart attempts to answer one simple question. What's the expected peak for the Fed funds rate? That's the interest rate the Fed controls, short-term interest rates, in the current cycle. How much more is the Fed likely to hike? To create this chart, I examined the next 9 Eurodollar futures contracts. Currently, the front-month Eurodollar futures contract is the EDZ2 contract, which expires in December of 2022, December of this year. And the 9th Eurodollar futures contract is the EDZ4 contract, which expires in December 2024. Now, Eurodollars represent a short-term, 3-month interest rate on US dollar deposits held outside the United States. The Eurodollar rate tracks short-term US interest rates and the Fed funds rate very closely, and this is an extremely liquid futures market. Eurodollar futures allow us to evaluate market expectations for prevailing short-term interest rates well into the future, looking at these different contract expiration dates. Now, my chart represents the maximum yield implied by Eurodollar futures contracts over the next 2 years. So this chart represents a good proxy for expected peak US interest rates over the next 2-year period. This chart begins at the end of June 2021, and you can clearly see expectations for Fed rate hikes were quite subdued at that time. For most of the summer of 2021, the peak expected Fed funds rate was only around 1%. Starting in the autumn of 2021, about a year ago, and accelerating into early this year, the market ratcheted higher expectations for the peak Fed funds rate. And after last month's much hotter than expected inflation numbers, that surged as high as 4.95%, retreating slightly over the last week or so. What's shocking is how closely this series correlates to the earnings multiple for the S&P 500. Now, to create this chart, I've plotted the peak rates data I just showed you based on the Eurodollar futures on the x-axis, that's a horizontal axis, against the contemporaneous earnings multiple for the S&P 500 on the y-axis, the vertical axis. Now, as you can see, there's a clear negative correlation here based on daily data since the end of June 2021. As expected, peak US rates rise, move to the right on the chart. The earnings multiple for the S&P 500 declines, so lower on this chart. Now, the dotted trend line that I've plotted here was plotted using a technique called ordinary least squares. And you can see the R-squared value for the trend line is a whopping 83.91%. Now, simply put, that R-squared means that market expectations for the maximum Fed funds rate over the next 2 years explain almost 84% of the forward price to earnings multiple for the S&P 500 since the end of June 2021. Now, I've labeled the current data point here as a red dot, which lies only slightly above the plotted trend line. What that means is that current forward price to earnings multiple for the S&P 500 is higher than the simple model would predict. The deviation, though, is less than 100 S&P 500 points. What that means is that in short, markets have already priced in a terminal Fed funds rate well north of 4.5%. Now, of course, if inflation were to continue to run hot and the Fed must hike significantly more than is currently expected to a terminal rate of more than 5% or even 6%, that could imply further downside for the PE multiple. However, for now, investors have already priced in the next 150 basis points, 1.5%, of Fed rate hikes by driving down the market's PE multiple. The relationship between interest rates and PE multiples is entirely logical. You see, stocks represent an ownership stake in a business, and the value of a business is equal to the discounted present value of all future cash flows generated by that company. Money has time value. And what that means is that $10 today is worth more than $10 earned in 5 or 10 years' time. There's only one question: how much less? Now, the answer to that question has to do with the discount factor. The higher the discount factor applied to future cash flows, the less investors are willing to pay today for future earnings and free cash flow. And the discount factor is correlated to prevailing interest rates. When the Fed hikes, the discount factor increases, which reduces the market's PE ratio. This also explains why the PE ratio for the NASDAQ 100, which relies more on distant future earnings and cash flows to support current valuations, why the PE ratio for the NASDAQ is even more sensitive to interest rates than for the S&P 500. Now, in this case, short-term interest rates explain about 76% of the NASDAQ 100's earnings multiple since the end of June 2021. Now look at the equation I've overlaid on the chart. As you can see, the slope of this equation is about negative 2.35 compared to negative 1.59 for the S&P 500. Essentially, that means every increase in peak rate expectations has a significantly larger downward impact on the PE ratio for the NASDAQ 100 than for the S&P 500. However, recall, as I said in the beginning of this, that there are two main fundamentals behind the price of an index, like the S&P 500 or the NASDAQ 100. The PE multiple I just outlined, and, just as important, expected future corporate earnings. And that brings me to this, what I like to call the bear's second act. I'm looking for the next wave of the equity bear market to be driven primarily by economic weakness and downward revisions to corporate earnings expectations rather than solely multiple compression or a falling PE ratio. To date, Wall Street expectations for S&P 500 and NASDAQ 100 earnings over the next 12 months have been buoyant. As you can see, Wall Street earnings estimates for the S&P 500 peaked over the summer, but have barely fallen since that peak, remaining within 5% of the early July highs. For the NASDAQ, the situation is a little bit worse. Estimates peaked on July 1st and are now down about 7.1%. However, as with the S&P 500, most of the recent selling pressure is down to rising rates and a lower earnings multiple, rather than declining estimates for future corporate earnings. However, while this might seem unusual, this is actually completely normal at this stage of the market cycle. Consider Wall Street earnings estimates for the S&P 500 back in the 1999 to 2002 era. As a reminder, in this cycle, the S&P 500 peaked in late March 2000 and entered a mild recession a year later in March 2001. The recession was over by the end of 2001. However, the stock market didn't bottom until almost a year later in October 2002. Now, S&P 500 estimates declined by a little over 15% from the cycle peak in October 2000 to the cycle low in December 2001. In other words, analysts started to reduce their estimates for corporate earnings after the peak of the stock market and before the economy entered recession, which I believe is about where we are right now. The pattern in 2006 to 2009 was similar, though the scope of the decline in corporate profit expectations was much, much larger due to the severity of the Great Recession of that era. In this cycle, Wall Street estimates hit a cycle high in July 2008, long after the market peak in October 2007 and the start of the recession in December of 2007. The total decline from high to low was roughly 42%, as opposed to 15% in that 2000 to 2002 cycle, with estimates finding a low only in March 2009, around the time the market bottomed and about 3 months before the end of recession in June of 2009. This point is absolutely crucial. The largest declines in both bear markets came after analysts started to reduce their earnings estimates and price in a US recession. Specifically, the entire decline of the 2000 to 2002 bear market was about 750 index points on the S&P 500. And about 88% of that entire point decline came after September 2007, which is when analyst earnings estimates started to come down in that cycle. In 2007 to 2009, the maximum point decline was about 890 S&P points, with 68%, more than 2/3 of that point decline, coming after Wall Street expectations for future earnings began to decline in July 2008. If the historical pattern holds, then the 24.8% sell-off in the S&P 500 in the first 9 months of this year is just an appetizer for what's to come. The decline in earnings estimates for the S&P 500 and NASDAQ Composite, as more analysts begin to factor a recession into their models, should bring about the more powerful and frankly painful second act of the bear market. So what about the pivot? Now at this point, some of you may be wondering about a potential Fed pivot on interest rates in 2023 as the economy sinks into recession. After all, following along with the analysis I just outlined, if the market starts to price in potential future rate cuts, this should drive down the discount rate applied to future cash flows and inflate PE multiples once again, right? However, historically, when the economy enters recession and corporate earnings begin to contract, the relationship between PE multiples and rate expectations breaks down. Take a look. This chart is a reprise of the scatter plots I showed you earlier, comparing the peak rate implied by Eurodollar futures over the ensuing 2 years on the x-axis, horizontal axis, against the contemporaneous PE multiple for the S&P 500 based on forward 12 months earnings estimates on the y-axis. The only difference is that instead of basing this chart on data since last June 2021, this scatter plot represents daily data from January 2008 through December 2009, which was during the last cycle, the last big down cycle for the S&P 500, the last big recession, the Great Recession in 2007 to 2009. The US economy was in recession, in fact, from December 2007 through June 2009, and the Federal Reserve was cutting interest rates for most of the period covered by this chart. As you can see, there's not much of a relationship at all. The R-squared value drops to less than 18%. However, here's what's even more shocking, is the relationship here flips to a positive correlation. What that means is that falling interest rates and rising expectations for future rate cuts actually drove down the price to earnings multiple for the S&P 500 in 2008 and 2009. Now, the truth is that there is some logic to that too. After all, when the Fed is cutting rates, it's usually a sign the economy is at risk of recession, or in this case, is already slipping into recession. Now, as you might expect, recessions represent a time of increased uncertainty surrounding corporate earnings and the outlook for future cash flows. And when uncertainty is on the rise, a rational investor is likely to demand a higher risk premium, which equates to a lower earnings multiple and a higher discount rate, to compensate for the risk of owning stocks. So be careful what you wish for. The main argument advanced by equity bulls in recent months has been that inflation is already peaking and will decline into early next year, allowing the Fed to cease hiking interest rates. Some have even been looking for the Fed to pivot and start cutting rates in early 2023. Indeed, this was baked into Fed Fund futures expectations as recently as early September. The bulls would argue that such a pivot and lower interest rates would prompt a risk rally powered by rising earnings multiples. Since earnings multiples for tech stocks and the NASDAQ tend to have higher sensitivity to rates than the S&P 500, the bulls' logic hold, these badly battered groups would be the big winners from a Fed pivot. However, I see two gaping holes in this argument. First, Jerome Powell's speech in Jackson Hole in late August, coupled with last month's very hot reading on inflation, cast doubt on the entire idea of peak inflation. The Cleveland Fed's trim mean and median indices are alternative measures of inflation that seek to eliminate components which add significantly or subtract significantly from inflation in a given month. The idea is to remove outlier CPI components that might bias the widely reported headline and core numbers higher or lower. These measures both soared to record highs of 6.7% year over year for median CPI and 7.2% for trimmed mean, respectively, based on data since the end of 1983. On this basis, peak inflation looks like a mirage. Thus, to bring down sky-high inflation in coming months, the Fed is likely to continue hiking interest rates and ultimately to keep rates in the 4% plus range for a prolonged period. There may even be more upside to short-term rates should inflation continue to run hot into early next year, which would keep downward pressure on PE multiples. Second, the bullish scenario assumes the US will avoid recession, both an economic downturn and an earnings recession, where profit estimates for the S&P 500 decline significantly. That's because a Fed pivot on rates in response to rising risk of an economic downturn, the linchpin of the bull's argument, does not boost earnings multiples as it would do in a more normal economic environment, such as the 2007 to 2009 experience illustrates. Instead, increased economic uncertainty and risk to S&P 500 earnings tend to prompt investors to demand a higher equity risk premium, lower earnings multiple, to take on volatility inherent in owning stocks. Let me be more blunt. When the Fed does pivot, it won't be good news, but a signal the US recession is already underway. The narrative is slowly but surely shifting, with market downside driven more and more by concerns about the economy, recession, and the resulting decline in corporate earnings. The real danger is this shift could accelerate as we move through third quarter 2022 earnings season for the S&P 500, which is now less than 2 weeks away. As you can see, analysts' expectations for year-over-year growth in S&P 500 earnings has barely budged since the middle of August, roughly the end of the second quarter earnings season. Indeed, over just the past week, analysts have revised down growth for current quarter, that's Q3 2022 earnings, by about 0.35 percentage points, and they've lowered Q4 2022 estimates by about 0.30 percentage points. However, Q1 2023 estimates have fallen only slightly, and Q2, second quarter of next year estimates, are higher than a week ago. 2 points. If there is a recession by the first half of 2023, I'd put the probability of that close to 90% at this point. These estimates remain far, far too high. Second, just as in April, May, and July, August, Q1 and Q2 2022 earnings seasons respectively, I'd expect analysts to start adjusting their models as corporate earnings releases begin to roll in for the current quarter, Q3 2022. That's a process that will begin in mid-October, with releases from JP Morgan, due before the bell on October 14th, alongside Citigroup and Wells Fargo. Note that none of this means the downside leaders, tech and growth, will stop falling, nor does it mean value sectors and energy will decline as much as the growth groups have done so far this year. Rather, what this shift means is that I expect the bear market to begin broadening out even more in the coming weeks, and for overall stock market declines to actually accelerate and intensify. Of course, the most important point of all isn't what's happening. Rather, it's what you can do to protect your hard-earned assets through the coming second act of this bear market and set yourself up to actually profit from the trends underway right now. Now, I don't have time in this short video presentation to go through all the steps I'm recommending to readers of my premium Creating Wealth publication. However, here's what I'm recommending in a nutshell. First and foremost, I've been recommending readers assemble a position in a number of inverse ETFs. These are exchange-traded funds designed to rise in value when key equity indices decline in value. And I've been assembling these positions in these inverse ETFs, recommending them in the newsletter since August. Now, this is not a new strategy for us in creating wealth. I last recommended a series of inverse ETF positions in December of 2021. Recommending readers book sizable profits on these positions back in May and June of this year, ahead of a potential summer rally I flagged back then, which did happen between mid-June and mid-August of this year. Now, with my expectations for significant, imminent market downside through the coming quarterly earnings season, I've recommended assembling a significant position in 6 specific inverse ETFs, tracking a number of different markets. Now, as I explained earlier, virtually all the market downside so far this year has been a function of rising interest rates, which hurts growth and technology sectors the most. However, I'm expecting this next phase of the bear market, driven by falling corporate earnings and a global economic downturn, to broaden out. In particular, I'm looking for more cyclical and value groups that have only been lightly touched by the bear market this year to be hit much harder by early 2023. So just last week, I have added to my recommended list of inverse ETFs to profit directly from market downside in a growing list of industry groups. Now, as we move through the final quarter of 2022, I'm also likely to recommend pivoting to the next phase of my strategy, which is taking advantage of bargains in select stocks and sectors that are likely to emerge as investors, as they always do, throw the proverbial babies out with the bathwater. My plan is to begin recommending small positions in select stocks, likely using specific limit orders to buy these stocks on dips. Generally, I'm looking for names that meet at least a few of the following criteria. 1, beneficiaries of multi-year bull market or super cycles in commodities, including energy stocks, precious metal stocks, and agricultural commodities. 2, stocks attractively valued on metrics like price to free cash flow. 3, stocks that can grow earnings and cash flows even through a period of weak US and global economic growth. 4, companies with manageable debt burdens, very important at this stage of the cycle. 5, companies with a plan to return capital to shareholders, either via dividends or share buybacks or some combination thereof. 6, stocks approaching logical long-term technical support levels on the chart, or showing persistent relative strength to the broader market averages. Now, this point is crucial. While I think a buying opportunity is coming in select stocks and sectors, it's still too early in the cycle to get started buying the dips, though I believe that point is coming very soon. Look, the truth is that I decided to rush out this video today because the shifts underway in the stock market and economy are happening even faster than I expected a few weeks ago. And the time to act is now. So I didn't have time to prepare a bunch of free reports to send you, as I might do in a more normal market environment. And given how fast things are changing, any reports I did create would probably be out of date just a few hours after I released them. So instead, I've authorized my team at my publishing firm, Capitalist Times, to open up risk-free trial memberships through my Creating Wealth service at the lowest price we have ever offered. That way you can follow along exactly what I'm recommending in real time, and you'll be the first to know of any changes to my recommended model portfolio recommendations via immediate and frequent flash alerts. In fact, in recent days, I've added several recommendations to the service, stocks and ETFs that I believe require your urgent attention. I'd like to rush those recommendations to you today as part of your risk-free trial. Here's how it works. To activate your risk-free trial right now, simply click the button adjacent to this video. That'll take you to our risk-free order page where you can start your trial at the lowest price we've ever offered of just $299 per year. As soon as your trial is confirmed and you accept my invitation, I'll rush you the last 2 issues and alerts for Creating Wealth, published in recent days, including my latest recommendations in convenient PDF format direct to your email. After that, you should expect to receive at least 2 issues of Creating Wealth each month, supplemented by frequent flash alerts with new recommendations, advice or updates on existing recommendations, buy and sell alerts. You'll also have access to my members-only email if you have any questions. Try the service for the next 60 days, 2 full months, and if you don't believe it's worth every cent of the subscription price, simply call or email us to cancel your subscription for a full refund of your $299 subscription rate. I guarantee it. Thanks for your attention today. I look forward to welcoming many of you as new members here in just the next few minutes. To activate your risk-free trial right now, simply click the button adjacent to this video or give us a call toll-free on 1-877-302-0749 between 9 a.m. and 5 p.m. Eastern Time. Again, that's 1-877-302-0749 between 9 a.m. and 5 p.m. Eastern Time. Thank you very much for listening to me today. I look forward to greeting many of you as new members of the Creating Wealth Advisory here in just the next few minutes.